Ways to quantitatively try to help the understanding of that is to add the dimension of time when you're doing your calculation as to what the value of something is. So the price is easy. That's the price. It's there available to you at this instant. The value, oftentimes, people are thinking of that, I think, in too short-term a time horizon. So if you're looking at it and you're thinking about the sum of the parts and what you could sell it at an auction today, that is valuable information, but it's not enough. There's more to it. So if you extend your time horizon to 3, 5, 10, 20 years, then you can actually start to do math around that of what discount rate you would like to earn on your investments, what rate of return you think a business can earn, and you can simply take two streams where you're projecting what you think the future value, future earnings will be, the future cash flows, and then you're discounting it back at a discount rate that you think is appropriate. And if you do that for longer periods of time than typically are used in the investment industry, I think you'd find that that price value mechanical equation gives you different results than what you would experience if you were using a shorter time.
But define fair price for us. How do you define fair price for us? Because in my research, I also came across a piece where you wrote about how the fair price allows you to earn long-term returns in line with the return on equity.
That's exactly right. So let's just say, for purposes of argument, you had a business that you thought the return on equity was 14%. Now you can do math and you can see that today. So the important exercise then is to think about, okay, next year and the year after that and the year after that, are they likely to continue to earn at least that 14% rate of return? If you develop confidence in the business and the management and all those factors that that return is indeed sustainable, that's when you can do the math of the math equation, where if your expectation is to earn 14% and you believe this business can earn 14% on equity, quite frankly, whatever valuation that company sells at, of price to book or price to earnings or any of those metrics, if you assume it will sell at a similar multiple at some point in the future. So if it sold for 20 times earnings today and you assume that it would sell for 20 times earnings 20 years from now, but they earn 14% in the meantime, your returns will approach that exact 14%. You can also do sensitivity analysis where you might, for conservatism purposes, say that, well, it won't sell at 20 times earnings in year 20, it'll sell for 15. That's straightforward math. That's still math that can be done and say, what will my rate of return be if it sells at only 15 times earnings at the end of that period rather than the 20 that it's selling for today? And does that still produce an acceptable rate of return for me as an investor? And that's how I would define fair price. If I am expecting to earn a certain rate of return and the price I pay logically supports the math of being able to earn that return, there you go, that's fair. Anything below that would be a bargain purchase. And I'm all in favor of bargain purchases when you can find them.
But what when the business becomes overvalued, like in the current market environment, right? And I take this question from the fact that you have holdings in Apple, Amazon, Alphabet in all of your portfolios. And valuations is what everybody's talking about when it comes to these businesses. And right, they're great businesses. They're in the right domain, doing extremely well, masters of their universe, but they're just getting too expensive.
There was a time where we did not have $1 billion business. There was a time where no business was $100 billion in market cap. You're saying there's no business that is $1 trillion market cap, but I suspect over the next 30 years, there will be several businesses that are over $1 trillion.
No, I completely agree with you.
And second point, and this is an important point psychologically because a lot of people miss this. They believe that for them as owners to really make returns, the market cap of the company has to grow. In this case, Apple is buying back its own stock. So actually, the market cap could shrink and you could still make more money. So it does not necessarily mean that they have to go to $1 trillion market cap. It's just a subtle point, but an important.
I want to address another key aspect, and which is really about how you're going to be looking at making investments in the current market environment, given valuations are so stretched, and what inflation, the expected rise in inflation plus the rising rate scenario can mean for profitability, thereby valuations going into the future? How are you, in a way, insulating yourself with that sort of a
Certainly.
scenario?
Well, I'm always leery of businesses that require tremendous capital investment on a regular recurring basis, because if you have inflation start to show up, the amount of capital expenditures that they have to do to keep the doors open and run the business goes up, and you don't earn proportionate returns as you see that happen to a business. But if you have a business that has brand value, intangible values, values of habit and just mindset, you don't need to keep reinvesting in that in the same way that you do with a business that requires a lot of equipment that wears out all the time. So frankly, the flexibility and the increase in pricing that they're able to get in an inflationary environment without having to spend and reinvest that money at the same rate of increase, that actually protects. It's not wonderful, but against the environment of inflation, that sort of pattern protects an investor as best as I know how to do it.